Hi guys, good morning everyone. This is Abid Khan and you are watching Karachians Academy YouTube channel. Here we are doing past papers of CIE AS level accounting. AS level accounting paper 9706, paper 1 of MCQs, variant 2. We have selected year 2022, attempt February March. So in our last lectures we have done with till question 11. So now we will start question number 12. So move on to question number 12. Very carefully you have to read the question, right? And what is required, both question and its requirement, very carefully. So question number 12, the year end of business is 31st of December. Remember, their business closes on 31st of December. On 5th January, inventory was counted and valued at cost rupees 30,000. Number one thing is wrong, because inventory for every business on the last day of its closing, it should be counted and it should be valued. Valuation can be done 1 or 2 days later, but it should be counted on the 31st, on the closing date, which is the cutoff date, 31st. So they have made a mistake. So how this resulted into different errors. So subsequently they discovered these errors and they have taken this 30,000 as closing inventory for 31st December. So what errors were discovered? Error number one, goods purchased and received after the year end. Okay, these are the consequences of wrongly counting and valuing the inventory post closing date. These are the consequences. So the year end, this for 1,500, 1,500 is inventory which was received after 31st December and during 5th of January. So this is the inventory of next year. So it has erroneously and mistakenly added in this 30,000. So this will be deducted. Move on to 2. Question number, error number 2. So included goods returned by a customer after the year end. Okay. After year end, on 31st, after 31st December, maybe on 1st, 2nd or 3rd of January or 4th or 5th of January. So some customer returned the goods. So by 5th of January. So one customer returned goods, which is your sales return. They have given you selling price and they haven't given you the cost price. Inventory is on cost price ultimately. So they have just given you the selling price, so it is not a issue. So because they have given markup is 25%, so you can calculate when markup is there, then cost remains 100% plus markup is 25%, and this will be your sale price, which will be 125%. So you already have 900 your selling price. So simply divided this by 125% and you will get the cost, 100% cost. So if we divide this by if I divide 900 by 125%, the 100% cost I will get to 720. So this is again inventory. Sales return means sales return your debit with the 720. Its selling price was 900. Okay, sales return was, it is your sale return 900, but its inventory cost is 720. So in inventory it should be 720, but it should not be the part of last year inventory. So this is wrongly included. So we have to consider 720, right? But what they have done, they have mistakenly the inventory of the next year they have included in the closing inventory. Okay, move to error number 3rd. Some goods including in the inventory costing 500 were damaged. Okay, they can be sold for 300 after repairs costing rupees 100. Right? It means here, IAS 2 on inventory, it says value inventory on lower of cost or NRV, right? NRV is your selling price. NRV is, what is it? NRV, this is selling price minus selling cost. If you are putting some cost, this is called NRV here, and your NRV is 300 is the selling price minus 100 is, so NRV is 200, right? And actually they include this inventory was included in 31st December inventory with 500, and its NRV is 200. So we have to see, this is wrongly included, so you have to deduct this and you have to include inventory at 200. So we can, this is very simple. So which value of the inventory should be included in the financial statement at 31st? Now they have previously they calculated 30,000. Now they are saying what should be the corrected inventory. We can work out, it is very easy. So actually your inventory is 30,000, right? What you will do, 1500 you will deduct, just 1500 you will deduct for error 1, right? And what you will do, right, on error number 2, 720, you have to deduct 720, error 2, right? Error 3, actually you have included inventory at 500, you need to deduct that, and you have to take inventory at 200. So this will be your new inventory. How much? 30,000 minus 1,500 minus 720 minus 500 plus 200. Okay, so your inventory is 27,480. 27,000. So your answer is A. Hope this question is clear to you. Just 1 minute. Okay, now move on to question number 13. What question 13 says? What your question 13 says? Just see this. Question 13. A sole trader provided the following information for the year ended 31st December. Right? Non-current assets increased by 25,000, current assets increased by 10,000, current liabilities increased by, okay. And this is very simple, this is, they are non-current asset plus current asset minus liabilities will be equal to capital. This is the very simple formula, and they are showing the increase. So we can do one thing, this 25, 30, 30,000 and okay. This is 25, then 35,000 minus 12,500. She will get 22,500. This is your increased capital. Increase in assets minus increase in liability. This is increased capital, the capital which is increased in your business, right? So this increased capital actually have the impact of the additional capital. Remember one thing, he has given you the position at 31st of December. So it has impact of profit, it has impact of drawings, it has all impact. So the whatever the increased capital you are getting 22,500, it has the impact of your drawing. This is already included in it, because this is the situation and this is the position of 31st December. So what we can do, and what was the profit for the year? So they are asking you to calculate the profit for the year. So it has the profit as well, because this is the ending position. Sole trader, where profit was normally transferred to the capital account, that profit has already been transferred. So this increase in capital shows profit and drawing and any additional capital, right? So it is already there. So what we can calculate the profit, no issue. Your increased capital is 22,500, and this profit is already included in it. Okay, so you have to calculate that profit. Okay, so additional capital introduced, this is also part of it. So which is additional capital is 20,000. Then you deduct that profit. Sorry, you deduct additional capital, because it is already a part of this increased capital. And drawings have already been deducted, so you add them. Simple, you reverse that calculation, right? This is the drawing, net difference, you will get the profit. Very simple. You can do 22,500 minus 20,000 and plus 13,000, 15,500, right? 15,500. So C is your answer. So we have done question number 12 and 13. Move on to next question, question 14. So question 14, what it says and what it requires, which rule does not apply? Remember one thing very carefully. He is not saying apply, he is saying does not apply. So very carefully, apply, does not apply in the absence of a partnership. Okay, interest on capital loan charge 6%, no interest on capital charge. Okay, no salaries, nothing. Okay, no issue. If you remember, when you studied the partnership, you studied the Partnership Act, I think 2006. Partnership Act 2006, I believe 2006. What it says, normally in a partnership agreement, you have number one, profit sharing. Number two, any salary in agreement. If you remember, in agreement you have to agree on profit sharing, salary to any partner. Number third, if interest on capital. Number four, interest on drawing. Fifth, last one, interest on partner loan. In partnership agreement, normally these 5 condition needs be incorporated in, and all your decisions will be done according to the agreement, right? In case of agreement is not there, then what the UK laws advises us, then you have to take all your decisions and disputes resolved as per the Partnership Act 2006. And what does it provide? As far as the profit sharing is concerned, in agreement, it could be whatever 70-30, whatever percentage. But what in case of a partnership, what they say, the Partnership Act provision says profit can only be distributed equally. There are only two conditions you have to follow. Rest, Partnership Act decline them. Number 2, it says only interest on partner loan, and that is only 5%. In your case, you can, the interest on loan can be 10%, can be 8%, whatever. But Partnership Act advises us that only these 2 things you can do. But if there is no agreement, you have to equally distribute the profit or loss. And if some of the partner has given you the loan, then only the percentage 5%. These are the 2 things which are. Otherwise, Partnership Act 2006 does not allow salary, does not allow interest on capital, does not allow interest on drawing. All these three, this does not allow. Act does not allow all of these things. Only 2 things, and interest is only allowed at 5%. So what the question says, interest on partner's loan, they are saying does not apply. Interest on partnership loan is charged at 6%. So this does not apply, because if it should have been 5%, then it can apply. It means this does not apply. This does not apply. Okay. No interest on capital is charged, right? He is right. Here he is right. This is wrong. No salaries are paid to partners. Very much right. In absence of a partnership agreement, profit or loss are shared equally. This is also, these 3 are wrong, right, and this is wrong. And what he is saying, which does not apply, the wrong one does not apply. So your answer is A. Hope for question 14 is clear to you. Move on to question number 15. We will do question number 15. What question 15 says? Okay, P and Q are in partnership sharing profit and losses equally. Always highlight the important points. On 1st January 2021, the partnership had net assets of 410,000. Net assets means this is capital, equal to capital. Net asset is equal to capital. At that date, R was admitted. On 1st January, they decided to admit R into the business on the following terms. This is the change of partnership, so the terms are getting changed. Net assets to be revalued 480, means it was 410, means revalue, they have increased value by 70,000. Goodwill was valued 50,000. Profit and loss ratios were changed. Initially it was equally, now 40-40 and 20. So what is the requirement? What was the change in the Q's capital? They are only asking, with the admission of this new partner, what change will take place in Q's capital. So this is very simple, we can calculate it. It is very simple. Okay, P, Q, R, these are the 3 partners. So then NCA revaluation 70,000, So this is revalued. So before admission of a partner, so this revaluation will increase your capital. What the current non-current assets will get debited, and revaluation reserves, sorry, partners capital will get credited. So this will increase their capital by equally. 70,000 is total, equal would be 35,000. He will get 35,000, he will get their capital will get increased. Nothing for R. They have created the goodwill. Okay, goodwill creation 50,000. So same is the case, goodwill will be debited and their capital will get credited. P and Q on the old ratios, old ratio was equal, so 50,000 means 25,000 will go to his capital and 25 to his capital, right? And when you will write goodwill, ultimately as per IAS requirement, you cannot keep the goodwill. Inherent goodwill you cannot keep in your book, you immediately have to write them off. So write off. We are written off of this goodwill. 50,000. If you are you are deleting it or you removing from your book, it will be on the current ratios. 40, 40, 50. So 50,000 0.4 40%. So 20,000 will be deducted from his capital, and 20,000 will be okay. 20,000 will be deducted from his capital, right? So how much would be you are required to show capital of Q? He is asking to give us the revised for capital, how much would be increase or decrease. So we can check it, no issue. 35 plus 25 minus 20, 40,000. So Q capital will increase by 40,000. Your answer is D. Okay guys, that's all for today. Or what in our we have done with till question 15. So in my next video, hopefully today, so I'll be doing the further questions. So that's all for today. So hope you have enjoyed this video. If you've enjoyed, please like it and share it with other students, right? And subscribe our channel so that you get every updated video on past papers. Thank you very much and bye for now.